Equity futures are higher ahead of the opening bells, as we saw and are seeing right there. But so far, January has seen some definite volatility. Our next guest tends to be a bit more on the bearish side. You may know him, adding that earnings growth estimates are too lofty, and he warns that overconfident investors might be in for a bit of a rude awakening. David Rosenberg is a veteran, a Bay Street and Wall Street investor, and founder and president of Rosenberg Research. There he is, right in front of me. How are you, sir? Good to see you.
Doing well. Thanks very much.
So let's start with this comment of yours that we're in a once-in-a-lifetime situation in equity markets. What is that?
Well, maybe it's not once in a lifetime. Maybe it's twice in a lifetime. Well, look, we have a situation where the multiple in the S&P 500 is now a 2.3 standard deviation event. And we've only been this expensive on the S&P 500 in 1929, in 1999, and we were there briefly back in late 2021. Both foreshadowed pretty rough years for the market that nobody saw coming, because the tendency for investors, well, for everybody, is to always extrapolate the most recent experience into the future. So I'm not going to say that valuations are a great timing device, but they're either a headwind or they're a tailwind. Big tailwind in the summer of 1982, big tailwind in 1991, big tailwind in 2003, big tailwind in 2009, big tailwind in 2020. This is a huge headwind for the market in terms of expected future returns. So that's the major point. Price is what you pay, value is what you get. And of course, the S&P 500 is populated with the best companies in the world. Who doesn't know that? All I hear about is US exceptionalism. Is that new? You see, this is what happens in my industry, right? Is that pundits take the narrative to fit into the price action. The US has always been exceptional. And these are the best companies in the world. However, there's just too much priced in as far as what their future growth prospects are. Next 5 years, the market is anticipating, this is what's priced into the market, 20% average annual earnings growth in the S&P 500 for the next 5 years. That's almost triple the historical norm. If you believe that's going to happen, if you believe that AI is going to drive productivity that higher and business costs that much lower, that we're going to get 20% earnings growth in the next 5 years, then I would suggest this market is for you. Not for me, maybe it is for you.
Right.
Valuations are just too high for my liking.
Yeah, and you may have some swampland for people as well, too, right? So now, in terms of this AI-fueled rally and the valuations that we're seeing, can you make comparisons to the 90s?
I think that you can. I mean, it's not the same, but it is similar. And everybody always says to me, well, you know, that was all dot-coms. That was a dot-com bubble. No. It was not just a dot-com bubble. We called it TMT back then. I was at Mother Merrill. We called it TMT, technology, media, telecom. You couldn't tell them apart. But you had Cisco, you had Dell, you had Intel, you had IBM, Microsoft. They all got caught up in the broad tech bubble. And these were real companies with real business models and real earnings, just like you would say about the companies today. Those are real cash flows, real earnings, real business models. So it wasn't just pets.com that went defunct. All these companies that are still around today went down between 60 and 80% from 2000 to 2003, and then they were in the penalty box for the next 10 years. Oh, by the way, this is even as the internet was boosting productivity and changing all our lives at a personal level. At a professional commercial level, all that and then some got priced into the peak. And that's what's similar right now. Generative AI, ChatGPT, this is a game changer, big time. But that's what the markets do, right? This is what I love about economics and the markets, is the markets are more volatile. They shoot first, ask questions later. And what I'm saying is that what is similar is that the last time you had a 20% CAGR, 20% annualized growth rate for earnings over a 5-year span, not 1 or 2, 5 years, was back in the late 1990s. Bottom line is that we know what happened next. So I'd say there's more similarities and differences under the proviso that it is not exactly the same. It rhymes.
Right. One of the things you point out, David, is that you call it a household overexposure. You think that too many people are exposed to the equity markets.
We have double concentration. We have the same degree of concentration on the mega cap stocks and technology that we had back in the late 1990s. If you're talking about what's similar, the degree of sector concentration is is about the same as it was back then. It's a very bifurcated market. What's different is that for the first time ever, households in the United States, not Canada, in the United States, have more than 70% of their financial asset mix in the equity market. And 60% of that almost is in ETFs, passive index funds. So you have a record degree of concentration in the stock market, coupled with record degree of concentration in household balance sheets and risk. And the marginal household in the United States, with the 401ks nice and fat with this big AI trade, they don't have a bloody idea what they even have in their portfolio. Active managers, they've been lagging the index, of course, because they focus on risk and they focus on concentration risk. The way you've beaten the market or matched the market is by taking on extreme concentration risk. If you remember going back to the old Nortel days in the late 1990s, that worked until it didn't work. But you see, that's my big concern, is that when we go to the other side of the mountain, and we always do, there's bull markets and bear markets, they coexist. In the next bear market, it's going to not just be a financial event and an economic event, it's going to be a social event, because everybody is all in all at the same time, and everybody thinks they can time the peak all at the same time, and that's not going to happen. But the fund flow, the concentration in equities is so huge that what happens when you get all the selling and there's no bid on the other side? Nobody talks about that. You see, when I talk about that, eyes just glaze and they roll. Because, of course, the extrapolation for the last 2 years of 25% returns, people think that's going to continue. You look at all my competitors on Bubble Vision, that's all they talk about. You have to ask yourself the question, why? Why does Warren Buffett, for the first time ever, why is he sitting on a 30% cash hoard? Okay, I'm not going to bet against his experience. A lot of people think, they said in the late 1990s that he lost it, Right. He's a Luddite. So we'll see. My recommendation more or less matches how Warren Buffett's positioned right now, which is very conservatively.
Right, and we'll get to that in a second. Something else you cite, David, is speaking of, so Buffett has 30% cash. Generally, portfolio managers have about 1% cash, so that's unusually low, isn't it?
Well, everybody is all in. Right? If you're an active manager and you're not all in the stock market, don't forget that they're already lagging the index anyway. So this is why everybody's going to passive ETFs and buying the index. But active managers, if you're not all in the stock market after what's happened the past 2 years, your clients are going to leave. So that's what's happening, is that everybody has become a momentum trader. Everybody, the strategists, the economists, the analysts, the portfolio managers, everybody's become a momentum chaser. And so that's why you've got historically low cash ratios even amongst these active portfolio managers.
And David, in terms of what you're recommending, how investors should be positioned, you have no problem with a 4.5%, 5.5% bond yields and some gold, correct?
Well, actually 4.5%. You get in the United States, and if you're a Canadian investor, at least you're picking up a good currency. You're going to get 4.5% in T-bills. I think that the Treasury market, the Treasury market has had its correction, and financial conditions have tightened. Now the stock market's paying attention. I mean, the rally that we're seeing in the overnight market is just because the stock market near term has become so oversold. But we've had a dramatic tightening of financial conditions. And so I think that the bond market, having already corrected, is looking very attractive. I mean, if we approach 5% on the 10-year Treasury note, I think that's going to be a very attractive entry point. We may already be there right now. I'd say that the 5-year part of the Treasury curve looks to me to be the most attractive, okay? I still like gold. That's a secular call. And as you had mentioned at the beginning of the show, the Canadian, if you're going to be all in on the stock market, all in. And I wrote this report and I said, attention U.S. investors, leave New York, come to Toronto. Because the one thing that the Canadian market does not have as an obstacle is valuations. The valuations here are actually compelling, both absolute and relative. And you pick up a very nice dividend yield where you don't get that in the United States. So I'm much more bullish, or let's just say a lot less bearish on Canada than I am on the U.S. right now.